Man, I am starving and it smells so good. I am so happy that we listened to Rob Abasolo and we came to Chipotle for lunch. He's on the way and he's going to be thrilled. Have you thought about what you're going to get, Christian?
Yeah, getting a burrito. Man, I love Chipotle, dude. Always healthy. Good stuff. Cheap. Love it.
All right. I'm going to go get in line. I'll get your order in. You wait here for Rob because he gets lost really easily. I don't want him wandering around like an old man where he can't find us. Tell me again, what kind of a burrito do you want?
Yeah, let's do chicken burrito, white rice.
Okay, cool. I got you. By the way, I know you've been in the gym lately and probably want to step up the protein. Did you want to go double chicken on that?
Not that's a good idea, but not right now. Not right now.
All right. That's fine if you just want to be a single chicken guy, I guess. But spice it up with some guac. You want me to get some guac?
I love guac and Chipotle's got the best, but honestly, man, not today. It's not in the cards today.
Dude, I got to ask, I feel bad. Why would you come to Chipotle and not get double chicken with guac? What's going on?
I'm also going to skimp out on the chips too, David. I spent all my money on my mortgage this month.
Oh, I hear you, man. On today's episode of Mortgage Monday, we are going to help you avoid this incredibly sad scenario. We want you to have all the guac you could ever eat. You're going to learn tips about how to save on your mortgage, how to navigate conversations with a loan officer, and how to keep as much of that money as you can for yourself. All right, Christian Batchelor, welcome to Mortgage Mondays. Okay, so when you are looking at lending options, a lot of people just say, well, what's my rate? As if there's one rate that everybody's offering. But that becomes a marketing ploy for people that are offering loans to make you think that they're going to give you a better rate than someone else. Can you explain how interest rates actually work, what a rate sheet is, and how closing costs are tied to the rate that you're given?
When you're comparing lenders, guys, you'll get a thing called a loan estimate, which has your interest rate, you'll have points you pay, and all the other third-party fees. One lender does not offer one rate. When you go into Chase and they say your rate's a 6.5, I hope everybody understands that any lender can offer a wide range of rates. They come with a difference in points. If you really, really want to get the lowest rate on the rate sheet and go down and spend a lot of money and get a lot of savings over the course of your loan, you want to spend points and get a lower rate. So that 6.5 may be a 6% if you pay a point. It can go the other way too. So if you want to get a 7%, they may credit you money. If a lender picks your rate for you, they're probably not a good lender. What they should do is present you the rate sheet, provide you options, and help you decide what the best one is for you. Analyze how much money you want to spend at closing versus what your budget is on a monthly mortgage payment that is comfortable within your living expenses.
Okay, now if I want to just compare this apples to apples, look, I hear you saying 6.25, I hear them saying 6.75. How do I know how much I'm paying for yours versus theirs? Because there's lots of ways for loan officers to kind of fudge this, right? They can give you a lower rate and just not talk about closing costs. Someone else might say, oh, I have the cheapest closing costs around, but they're not telling you they have a higher rate. What advice do you have for how a borrower can actually line up these two options and see which one is cheaper?
Yeah, the technical term is compare the APRs. The APRs is not your interest rate, guys. The APR is a combination of your rates and your closing costs. The problem is lenders can fudge it a little bit. What you should compare is only two numbers, the interest rate and the points associated with the interest rate. So if I offer you a 6.25 and Chase offers you a 6.25, I'm charging $0 and Chase is charging $2,000. I am $2,000 cheaper than Chase. That's it. That's as easy as it gets.
If I hear you right, instead of saying, what is your rate? You can start with that conversation. And let's say they say 6.5. You say, great. What are the points associated with that rate? What are the fees? What's the verbiage that someone should use?
What's the rate and what does it cost is what I would say.
What does it cost? Okay. Now, is there a certain form that they can send that information out on?
They can. It's a loan estimate is the official term. Prior to a loan estimate, most lenders are hesitant to send it out. You can get a rate quote sheet, but loan estimate is like the official, with the stamp of approval on it that was actually generated for you.
So say, hey, can I get a loan estimate? We used to call those a good faith estimate back in the day when I was first investing. You would ask for a GFE. Okay, so there's your advice, everybody. Don't just say what's your rate. Maybe start the conversation there, but understand it's largely worthless information. What you want to say is, can I get a loan estimate for a loan at whatever that rate is that you said? Then you can ask the same thing to a different lender to see who's actually going to be cheaper. Okay, something else that people need to know to get the most out of their mortgage is there's going to be closing costs that are associated with a loan. Can you very briefly just discuss what closing costs are and what people can expect to pay on a purchase price of, say, $300,000?
Absolutely. Closing costs, not to be facetious, are the cost of closing. They do include the fees that we just spoke about, right? The appraisal has an expense. I said $500 to $1,000. The lender has a cost, the points you pay for your rate. They also include all the third-party expenses. So there is a title and escrow company that typically is responsible for helping you facilitate the closing. There is property taxes and homeowners insurance that is usually due on a closing. closing. There are government recording fees, right? The government takes a little portion when you buy a house, right? There's a fee that they collect for that. All of those fees collectively combined are called your closing cost. It is the cost to acquire real estate or acquire financing for real estate. And typically most lenders can estimate it between 1.5% and 3% of your loan amount is typically what you can expect in terms of closing costs. So if you got a $500,000 loan, you can expect, maybe 10 grand to 20 grand in cost associated with your closing.
And that's for the lending part, right?
All things combined.
All things. Okay. So that's going to include title and escrow, transfer taxes that you're going to have, the lender's fees you're going to have. And then on top of that, if you're a seller, you're going to be paying some real estate commissions. Typically buyers don't have to pay those. Now, here's why I bring this up. This is a pretty significant expense. If you're just saying, well, I'm going to put 5% down on this house, but you're not thinking about your closing costs, you might not have enough money. You also may not realize that some lenders are going to require you to keep a certain amount of money in reserves, at least when you first close. So that's even more cash you have to have. So the cash becomes the stranglehold on most real estate investors. Not only do they have to find the deal, but how do they find the money to do this? Enter credit from sellers. There are ways that you can get the seller to credit you money at closing that will cover your closing costs. Now, Christian, can you explain how that works and why you cannot get a larger credit than what your recurring closing costs are?
Yeah, there are limits. You cannot get a credit for your down payment is basically another way of saying what you're saying, David. You can cover every other expense outside of your down payment. So if you guys want to get a $50,000 seller credit, it's probably not going to work. Typically, you can get around 3% of your purchase price as seller credit. So a $500,000 house, you can get 15 grand. Right? That's a good rule of thumb. What those credits can go towards is paying all those closing costs. So those title, escrow, everything that we just discussed. It could also buy down your interest rate. So $15,000 today could save you $150,000 over the course of your loan if you buy down your interest rate, right? And that's how a lot of people in more competitive or more tough interest rate environments are combating them. They're having the seller pay down their interest rate, right? So instead of getting the market rate of today, you're getting the market rate of, maybe 6 months ago, right? Before the rates increased, and the seller's paying for it. And then obviously that all comes down to negotiation with your realtor, so make sure you have a good one.
But in general, as a realtor, I tend to favor receiving money back in the form of credits from the seller as opposed to decreases in purchase price, because that's cash that you have that you can use for many things. If you get a $20,000 credit, you can spend it to improve your kitchen and bump up the price of the property by $40,000. You can have that as reserves to buy more real estate. You can have that as reserves in case the property doesn't cash flow, if in case unexpected repairs happen, or as part of the down payment for your next property. So don't assume that the only way that you get something from the seller is to lower the price. That's actually harder to get. Most sellers are much more likely to give credits, even though that doesn't make any sense. Okay, we have covered what to do if your appraisal comes in low, how to compare apples to apple loans between different loan officers and loan options, as well as ways that you can save cash when you're buying real estate. Now let's get down to how you can get money back from the lender that can cover some of those closing costs if you can't get it from the seller. Can you explain what a lender credit is?
Absolutely. It can come in multiple forms. The most basic one is in terms of the rate sheet that we have already discussed. Just like I said, you can pay points to buy down your rate. If your par rate, which is just where it costs 0, is 6.5%, let's say, you can go up to a 7%. Now, most people would scoff at this. I don't want a higher rate. Well, hold on. What if that rate paid you $10,000 right now? So what if you could get $10,000 of your closing costs knocked off? That's $10,000 you can now spend on your appliances or your furniture. If you're buying an Airbnb, you can furnish it. If you're buying a primary, you can redo your kitchen. Instead of using that for closing costs, you can use it to increase the value of the property and build equity. And that can come in form of a lender credit, which is the result of taking a higher interest rate on the rate sheet than what the par value is.
Now, you've heard the phrase buying down your rate. That's where you pay more money to get a lower interest rate. This is just the opposite of that. Hey, I want to spend less money in order to get a higher interest rate. Now, this gets fun when you combine that strategy that you talk about with your loan officer with the negotiation strategy that you talk about with your realtor. If your realtor doesn't understand this, it's harder for them to negotiate a deal for you when you have leverage in negotiations. Let me give you an example. Let's say that you are able to negotiate a $10,000 closing cost credit from the seller, but your closing costs are $20,000. You may want to have a lender credit for $8,000 to cover the majority of the $10,000 that you couldn't get from the seller. That's where having this information can work in your favor to keep your closing costs lower, keep more money in your bank. And then you just take that extra 20 grand and you put a new roof on the house, or you do something that makes it worth significantly more money. Maybe the seller had to take a haircut on the price because it needed a new roof or some issue like that. But what happens if you're able to negotiate a $35,000 closing cost credit, but your closing costs are only $20,000? I've seen this happen before too, with realtors who don't know what they're doing and clients who don't listen to Mortgage Monday that just forfeit that $15,000 at the closing table. You're legally not allowed to receive that if the credit is in excess of what your closing costs were. So one of the things that we do at the one brokerage is we'll go back to the realtor and say, hey, we are going to buy down our client's rate from 6.75 to 6.25, but that means that it's going to cost them $15,000. Remember that we said that every rate is available by every lender, but they cost different money. So now because we're buying the rate down, that's going to increase their closing cost by $15. That will now cover the amount of money that was negotiated from the seller, and we can legally do it. And now our client gets a rate at 6.25 instead of 6.75 that the seller effectively paid for. If your lender and your agent are not working hand in hand and they don't know this information, or you don't know this information, you would never understand how much money that you could have saved combining these things together. So that's why understanding that a lender credit is money that you get back from the person giving you the loan in exchange for a higher rate. And a seller credit is money that you get back from the seller of the house that happens in negotiations, particularly when you have some form of a contingency. So let's move into the last piece here. Third-party fees. These are things that you're going to pay whenever you get a loan. We briefly covered them. Can you just go over again, Christian, bullet points of what third-party fees are and what advice you have for how to save money on these?
Particularly, I want to hone in on that second part of your question, David. This is where you can get into the unfortunate dishonesty in our industry. And this is when you're comparing lenders. Third-party fees, to answer the first part, title, escrow, homeowners insurance, property taxes, yada, yada. However, on that initial loan estimate, we talked about that first document you receive with the quotes on your loan, you will get a loan estimate that has those fees. The problem is the lender doesn't really have to be honest about those fees up front. So I can say that your homeowners insurance policy is going to cost $40 a year. It's not. Okay. It's probably going to be $3,000 a year. However, borrowers are always drawn to a certain line on the loan estimate that is titled final cash to close. That will include all of the fees that the loan officer input. So if I input that your homeowner's insurance is $40, I'm going to have a cash to close representing a $40 insurance policy. Whereas if you have a loan officer that's being more accurate and more honest, he's going to quote and say, hey, it's probably going to be $3,000 to insure this property in Florida. You're going to be $3,000 more expensive than the other lender, but you're honest. The thing I'm trying to say, no matter which lender you choose, the third party fees are the same. Okay. This is, if you take one thing from this video, third party fees do not vary by lender. The lender does not get you cheaper title or escrow fees. The lender does not get you a cheaper appraisal. The lender does not get you cheaper homeowners insurance or property taxes. The only thing to look at when you're comparing lenders is the thing we said earlier. What's your rate and what does it cost? That's it. Even if the loan estimates differ on those other items, they will all be the same by closing, no matter who you go with. The only things that will differ, what's your rate? What does it cost? Remember that, guys. When you're next talking to your lender, ask them those two words and just ignore everything else on their loan estimate because it's going to be the same.
Cut right through the BS, because you tend to find that when somebody is, I don't know how to say being dishonest, but they're being a little less than ethical, they make a straightforward, simple thing more complicated. That's smoke and mirrors, right? The people who know that they're giving you the best service or are the most direct will usually just tell you what you just said. Hey, what is your rate? What does it cost? That's what I want to know. And then you can easily take that information and compare it to someone else. Now, I will add this caveat. Just because someone's the cheapest doesn't mean they're the best. It doesn't mean they're not the best, but don't assume that the cheapest cost and the cheapest rate are your best option, because those are usually associated with the worst service, the least options, and the most chance of blowing up your deal because they screwed it up. So just like you can probably buy cheaper products at a flea market, that doesn't mean that they're going to hold up or stand up as well. If you're trying to buy a high quality investment, you don't want to be shopping at the flea market. But this still does really help borrowers get into a situation where they can feel comfortable that they're not being ripped off. So let's sum this up. We've talked about the rate sheet structure, what a par rate is, the fact you can buy down your rate or you can get a credit if you go higher. We talked about how to get credits from the seller. Everyone needs to be aware of this. If you are a real estate agent, you should be paying attention to this stuff. You should be following me to learn how to be better at doing that. You should buy the books that I wrote through BiggerPockets Publishing to learn how to do that better. We talked about using the credits from the seller to buy down your lower rate or combining them with lender credits to eliminate closing costs. And then we talked about third-party fees that are non-negotiable that you need to know. It doesn't matter who your lender is. These are going to be fees you're going to have to pay. Look, everybody, what we want is for you to save more of your money in the bank so you can use it to buy more real estate, not dump it into your projects in ways that are inefficient for you, because saving money is freaking hard. And if you've been through all the work of doing it, we want to see you keep more of that money. Christian, if people want to reach out to you, they want to get a loan estimate, they want to learn more about what you could do for them, where's the best place for them to go?
Yeah, guys, social media, best place is Instagram at The One Broker is my handle. And our website's theonebrokerage.com. Apply now link, top right corner.
There you go. And you can find me at davidgreen24.com, or you can follow me on social media anywhere at davidgreen24. This has been another episode of Mortgage Mondays. If you have a second, search YouTube for another one of these suckers. We love making them for you. Let us know in the comments what your favorite part of today's show was. Did you learn something that you didn't know? And are you glad that you listened to this? And if you don't have any more time, that's great. Get back to work, and we will see you next Monday on Mortgage Mondays.